Hey everybody, welcome back to the channel. My name is Justin, and today I'm going to be doing a full stock analysis on Tyson Foods Stock, ticker symbol TSN. I'm going to be answering questions like, what does this company do? Do they have a competitive advantage? What does their 10-year financial history look like? What do I come up with a valuation for today's stock price? And most importantly, what do I think the return on investment is based on today's stock price and also future stock prices as well? If this is the first video you watched of mine, my name is Justin. I'm a value investor. I follow people like Howard Marks, Warren Buffett. I took Phil Town's investing course many years ago. On a personal level, I am a CFO of a manufacturing company. And so I try to, tailor what I've learned from Phil Town, these other super investors, also what I have learned over my 20 years of being in accounting and finance and trying to tailor a strategy that really works for me. So I tend to keep about 20 to 25 stocks personally in my personal stock portfolio. I am up over 40% year to date, which I'm really happy with. Obviously, so far I'm beating the S&P 500 by more than double thus far this year. So maybe Tyson Foods might be of interest to me and maybe interest to you as well. So let's just dig right into this video and the stock analysis. And if you get some value out of this, go and hit that thumbs up button. Really helps out the channel a lot. And let's get started. All right, so let's start with a business overview for Tyson Foods. What do they do? Most people would probably recognize them. They're one of the world's largest food companies and recognized as a leader in protein. They were founded in 1935. They have a number of really big brands that you would recognize, from Tyson, Jimmy Dean, Hillshire Farm, Ballpark, Wright, Idols, I'm not sure how you say that, IBP, and then State Fair. And actually, from a United States perspective, they produce and provide about 20% of the beef, protein, and chicken in the United States. So they obviously offer a big chunk. In fact, they're the leader in their space overall, I would say. And we'll talk more about that coming up. All right, a little bit more. Now, if you look at 2022 sales, this is kind of sales by segment here. They did about $53 billion last year, which is massive. Now, 36% of their sales came from beef, 32% came from chicken, 18% came from prepared foods. Then you have pork at 10% and international or other at 4%. Now, this next slide here really gives us an idea of what type of competitive advantage that Tyson Foods has versus their competitor. So this is brand strength relative to competition. And as far as frozen nuggets go, for example, Tyson Food comes in at 42%. Their closest top branded competitors at 8%. Frozen strips, you have 37%, Tyson 7% competition. So you look through this thing, but in general, that kind of gives you an idea how great of a competitive advantage that Tyson has from their name brand versus their competitors just in general. And across the board, they're by far their number one across all these different categories here, which is quite impressive indeed. Now, as far as fiscal year 2022, if we look at beef, pork, chicken, and then prepared foods. Those are the biggest categories of sales that they have. And so beef, for example, they're at 79% average capacity utilization. They have 14 facilities, 155,000 head per week capacity, and you can kind of see across the board in the different areas. But certainly chicken, pork, chicken alone, 185 facilities, which makes a lot of sense because chicken is one of their biggest providers that they have, obviously, as far as sales goes. There. If we go on, this is some of the current challenges this company has had, and we'll see how much their stock has really dropped over this past year. But they continue to see challenges in different areas, beef and chicken specifically, and pork as well. In fact, I would say pork has probably been their largest challenge that they've had. Now, as far as sales go for beef, you can see year over year it's dropped slightly. Their adjusted operating income is actually up compared to last year, so that looks good from a beef perspective. But they're still seeing decreased and lower head processed overall in the second quarter of this year, which they just came out with their earnings not too long ago. 2023, the second quarter average sales price decreased due to reduced domestic demand and softer exports internationally. Now, if we go on and take a look at Pork, for example, you can really see the challenges there. So on a sales perspective, it dipped, but look at the operating income. They're actually negative. So from, go back to beef, they're at least positive, not great. Their operating margins in general across the board are much lower than other industries. Their gross margins are around 12, 13%. Their operating margins are around 7, 8%. So in general, they have really, really compressed small margins versus a lot of other industries. So when you're running, negative operating margin on one of your sales segments, which is pork at around like 10%, I think what it was is your overall sales. That's very problematic overall indeed, and it's actually dropped even further from a year ago, and that's one of the reasons why their stock price has fallen so much. So in the second quarter, sales volume increased due to improved hog availability. Average sale price decreased due to soft global demand. So again, international demand falling. Operating income decreased due to compressed pork margins and increased operational costs overall. So again, those are some challenges that they had. Another reason why their stock price has dropped so much, they lowered their sales and margin expectations overall. So they thought sales growth would be in the 3 to 7% growth range for 2023, and then they just dropped it down to 0 to 1%. So they're saying almost no growth for this year, which is obviously very problematic indeed. Their chicken margins, they said 2 to 4%. Now it's going to be anywhere from maybe 1% to negative 1%, which is a huge problem, obviously. So not good overall when you're coming out and lowering your guidance for the year. You're going to see a price drop just in general overall. Now, as far as a financial history for the last 10 years, I'm a little different than others. I kind of take Phil Town's perspective here, and I look at a per share basis. So sales per share, earnings per share, free cash flow per share, book value per share, instead of looking at sales just by itself directly. I like to look at the per share basis. It gives me a good idea. Are they buying shares? Are they selling more shares? That will impact, in my personal view, on what the stock price or future stock price will be moving forward. So from a sales per share standpoint, on a 10-year CAGR basis, they're up 4%. Over a 3-year basis, they're up 8%. But look at this free cash flow. Look at that, just completely fell off the face of the earth. Also, earnings per share, due to those compression and margins that we just talked about, international demand falling, operational costs increasing over the last year or so, have really hurt the business overall. But two things that stood out to me, actually three things that stood out to me right away. Look at book value per share. That is tremendous. Over a 10-year period, around 12%. So even though free cash flow per share, earnings per share have fallen off, book value has increased. If you know what book value is, as basically equity of the company, as assets minus liabilities. And so their assets have grown faster than what their liabilities have overall, which is absolutely fantastic. Another thing that stood out to me too, return on invested capital, that basically tells you how efficient the company is at earnings or producing earnings based on money that is given to them by shareholders and also acquiring debt as well. So 9% is pretty good. I like to see it in the double digits, but that's not far off from that. So 9% is pretty decent. And then the third thing that really stood out to me is the debt to equity. So it's pretty low. In fact, I was really shocked, as big as the company is, how low it is. So from a debt to equity perspective, I like to see it under 100%, preferably under 75%, and then anything under 50% is excellent. I really do say this company has done a very, very good job on keeping their debt low compared to their equity and versus what their operating earnings have been overall. And their operating earnings have been fairly consistent up until this year, and then you have to go back all the way to 2013 and 14 to really see that drop. But really, they've been pretty average, around 7.5%, almost 8% over the last 10 years. So pretty interesting overall. So that's kind of their 10-year history. So even though the last couple of years we've really seen a drop in free cash flow and earnings, the business still looks pretty solid from a balance sheet perspective. And then also from a sales perspective, they haven't really fallen off. In fact, they've increased 8%. Increase over the last 3 years per year versus, historically the last 10 years has been 4%. So that's still pretty good. It looks like they're going through some headwinds right now, but I think they could probably get over those, was what it looks like. So from a stock price perspective over the last year, the stock is down 35%. They were up almost at 90, and right now it's trading between 50 and 55. So it's fallen 35% over the past year. And it has to do with all the stuff we talked about, the challenges and the recent guidance revisions and all that stuff there. Now, as far as a valuation goes for this company, this is a discounted operating earnings model that I personally like to use. And what I'm trying to do here is trying to figure out what is the revenue growth going out into the future. So this year, I think they're going to be around $54 billion in total sales, or $53 billion last year. And I think they're only going to grow roughly maybe 1% on the top line. That's it this year, and then only 4% going out. So over the next 5 to 6 years, I think it's only going to be around a 4% roughly growth on the top line for this company. And now as far as operating margins go, last year they're around 8.3%. I think they're going to be around 7.5% on average over the next several years. And that's pretty much in line where they have been. So I don't think that is out of the ordinary or anything like that. But overall, I think operating earnings is only going to grow roughly around 1%. So sales growth around 3.5%, 4%, operating earnings growth just around 1.5% overall. Now, based on a multiple of 11, and if we go back to what I just showed you before on this multiple here, on average, this is kind of where they have fallen out over the last 10 years. So on average, they've been around 11. Here, the last 3 years, they've been trading at a 9, and this is an EV over EBIT multiple, if you were kind of curious. So I think an 11 is conservative. I mean, that's where it's been average over the last 10 years. And I think they have an opportunity of really improving their margins, getting back to kind of historical averages over the next couple of years. So based on that, I get an intrinsic value of $73 for this stock, which is around a 30% margin of safety overall based on these assumptions. So you might be asking, what kind of returns would I expect based on these assumptions? And this is what I come up with. So for example, if the stock is at $48, I would expect a 20% return on investment per year for the stock over the next several years. If the stock is trading at, say, $73, I would expect somewhere around a 10% return on investment based on this stock price. And again, just a quick summary, this is based on these assumptions: sales growth of 4%, and then operating earnings roughly about 1% at a multiple of around 11. All right, so that was my stock analysis on Tyson Foods. It definitely looks like they're undervalued right now based on today's stock price. Now, you should always do your own analysis. These are just my assumptions, my opinions, what I'm coming up with. So don't just listen to someone on YouTube. Make sure to do your own analysis there. But I will say that I do use other valuation models as well, not just that operating earnings discounted model that you saw in this video. I look at a 10 cap valuation, which Phil Town talks about and teaches, payback time as well. I also do a margin of safety calculator, which I've talked about in other videos. And ironically, if I do those other three, it looks like it's a buy right now. So I would be curious from you guys' standpoint, do you think Tyson Foods is a buy right now? Do you think they can overcome their challenges that they're facing right now and get back to kind of more historical means? I'd love to hear from you guys there. And if you're curious and wondering how to value companies, I do offer different valuation templates on my Patreon, which I'll put a link down below if you're interested to get access to the Discord channel on there as well. And I do have posts on my Patreon that are only for my Patreon members as well. So thank you so much for watching this video. I really appreciate it. Love to hear you guys in the comment section. Don't forget to hit that like button on the way out. I'll catch you guys on the other side. Take care and God bless.